Hey everyone, my name is Mabel, and today we'll be going over financial valuation. So valuation is the analytical process of determining a company's or asset's value. When we use the word value, we really mean the fair value, so what a buyer should pay for the company or asset. So for example, if we think about the recent Amazon acquisition of Whole Foods, Amazon paid $13.4 billion for Whole Foods. So bankers essentially had to determine a value of Whole Foods. They utilized various methods that we'll go over in a bit to come up with this number, $13.4 billion. So there's two main categories of financial valuation for a company. So first, there's intrinsic, and second, there's relative, and we'll go over some methods for both. So first, we'll go over discounted cash flow, or DCF. So a DCF valuation method is basically when you determine the present value of future cash flows and you discount those cash flows back to the present time. So in this analysis, you basically calculate future cash flows and the discount rate, which is also the weighted average cost of capital, using company financials, and we'll go over just an example of a model in a second. But many people prefer a DCF because it is intrinsic, so they think that DCF is more reliable than relative valuation methods that might be influenced by how the market's doing or other extrinsic factors. DCF purely uses a company's financials and some multiples here and there. The model is also nice because it allows for sensitivity analysis, and it also allows for you to build in various scenarios. So here we have just an example of what a DCF model might look like. So you can see that right about in the middle, the model utilizes various financial metrics to calculate unlevered free cash flow, which is basically a company's free cash flow in the absence of its capital structure. And then it uses the weighted average cost of capital to discount those future cash flows, free cash flows back to present value. So the next method we'll look at is the comparable companies analysis method. So this is one of the extrinsic valuation methods. Basically, you compare the current value of the company to other similar businesses. So when we say similar, we really mean in the sense of industry, geography, and size. And we compare companies based on trading multiples, most commonly PE and EV/EBITDA, but the multiples that we use do vary based on the industry of the company. So in this example here, there are 5 comparable companies, and you can see that they utilize 3 different trading multiples, so EV sales, EV/EBITDA, and PE. And basically from this method, we come up with sort of a median or average multiple for our current company that we're analyzing. And so this method is good when good comparable companies actually exist, which isn't always the case. The next method that we'll look at is precedent transactions, which is another extrinsic valuation method. In this method, you compare the company to previous similar companies that were either sold or acquired, and you basically look at how much previous companies were sold for or acquired for. And so this method will actually give you the highest valuation because of the control premium. So whenever a company actually acquires another company, they'll tend to pay above sort of the true valuation that the bankers estimated in order to gain a control premium over the company. And so this method is good whenever there are existing good precedent transactions that fit in the sense of the company's profile. So bringing everything together, analysts don't want to just focus or rely on one method because that's not very reliable. So analysts will usually utilize various methods and sort of look at the valuation that was determined from each method and then compare them on something that looks like this graph right here, which we call a football field. So you can see here that there are 5 different valuation methods that are compared, and each method has a range. Then the football field looks at the median of those ranges to come up with the sort of best recommendation of a company's valuation.